This one will be a farmland asset presented by Josh Guggenheim at Gold Leaf Farming. Josh, there you are. Welcome to Alts Expo. Great to see you again, Josh. How are you this morning?
Hanging in there, hanging in there. What about you?
Good. Yeah, we're doing great. We're off to a great start.
Thanks everyone for joining. I know it's been a busy day. My name is Josh Guggenheim. I'm the head of acquisitions at Gold Leaf. Not sure if you're familiar, if you've heard about us on Jimmy's other podcasts, but the way to think about Gold Leaf is we are a mix between an investment firm and a farming operating company. We buy specialty farmland in California, so almonds, pistachios, etc., operate them with our own in-house team, and deliver cash flow to investors through operations and appreciation. Today, I think it's going to be a successful presentation if I answer these three questions. I want to talk a little bit about why specialty farmland. I want to talk a bit about why GLF as a firm. And probably the most interesting one is why now? You guys obviously have a lot of different options to invest in. And the key question sometimes is not which asset class, but why now? And it's an awesome time to invest in specialty farming. So I'm excited to share that with you guys as well. So taking a step back, I'd assume most people on the call probably didn't, grow up on an almond or pistachio farm. I personally didn't. So to take a step back before we go into it, I think it makes sense to kind of set some ground rules on what makes a good investment. And I think there's really, four key components to think about. And really, how do we stack up as specialty farmland, which is the answer that we'll get to. First one to think about is obviously macro trends. You've got to be on the right side of supply and demand. You can have an awesome company, an awesome team, etc., but if you don't get supply and demand right, it's pretty hard to have a good investment. The second one would be fair pricing. Every single investment grade, whether it's Warren Buffett or Marx or whoever it might be, talks about pricing. Seth Klarman also talks about fair pricing in Margin of Safety. You've got to buy at the right price. You've got to buy low and sell high. A lot of great investment opportunities have been undone by prices that are too high. The third one I would say is value creation opportunity. It's great to buy a good deal, but it's even better if you can buy a good deal and the team that buys it can basically increase the income and then exit at an appreciated value. It's not such a great opportunity if there aren't any low-hanging fruit. And the last thing is obviously tax efficiency. No one wants to have a good gain and then give it all back to the government. So how do we stack up? First thing, macro trends. I mean, the big question here, or the big answer here rather, is there's a lot more people. World population is continuing to grow. We'll be at 8 billion people soon. Those people are hungrier and hungrier. The number of calories that are consumed, for example, in India or China have basically doubled in the last 30 years. So you've got a growing population, it's hungrier and hungrier, and there's less and less land. There's something like 60% less land per capita now than there was 50 years ago. So as a result of that, we as humans are going to have to produce more food in the next 40 years as we have in the last 10,000 years put together. So obviously farmland, the land that produces this food, is increasing in value. Next thing is fair pricing. We are buying our properties at 10, 11, 12% cap rates. You don't see that in other real estate assets. Multifamily might be 5, 6, 7%, office maybe 7, 8, 9%. But we're pretty excited about being able to buy at a good price for two reasons. One, it's great cash flow, and two, it's safety. If cap rates compress a bit, we're obviously going to be in good shape. But what if they go up? We still want to be able to exit for a profit. You don't want to buy real estate that you say you buy it at a 6 cap and then you sell it at a 9. Not going to be so good. So when you think about price, we're really talking about safety too. The value creation opportunity, we are mostly buying from family farmers. These farmers are about 70 years old. 2/3 of them want to sell. They aren't investing into their farms. They're ready to exit. So as a result, there's a lot of low-hanging fruit, no pun intended, for us to increase value on the farm. And last but not least, it's a super tax efficient asset class. All of our farmland improvements can be bonus depreciated. These good, this background has basically meant that returns have been really good for our crops in the last 20 years. Almonds and pistachios have averaged actually 20% per year in the 20-year period. One issue, though, is that it's pretty hard for investors to access this asset class. There's tons of groups doing multifamily or office. There aren't that many doing specialty farmland. Only 2% of specialty farmland is owned by investor groups, whereas for office or multifamily, it's much, much higher. So our story as a firm, we're about 7 years old, and we were founded to solve this problem and basically create a world-class platform that allows investors to get access to this good asset class. Fast forward a lot of hard work later, we've currently got about 26 properties, about 12,000 acres, so 12 times the size of Central Park, throughout California. All of the farms we own, we operate ourselves with our team. We only focus on super supply constrained farms, and we do excellent water rights diligence. A lot of people ask, oh, isn't California, in a drought? What do you guys do with water? And the answer there is about a third of farmland in California has rough, not great water rights, but about 2/3 has, excellent water rights or good water rights is what I would say. We focus on only the best, and frankly, by investing in our partnership, it's probably the best way to get access to water rights, which are definitely going to appreciate in the future. I mentioned, doing operations ourselves, and everyone mentions, doing operations themselves creates value and that we have low-hanging fruit too. I wanted to give a specific example to kind of illuminate that. GLF3, you see the satellite image here, is a nice, it's about 700-acre almond farm, about 10 minutes away from Sacramento Airport. So if you're ever in town, actually let us know. We're happy to give you a tour. We bought this farm about 4 years ago, and it was an okay farm. It was doing about a 4% cash yield on equity. Nothing that special at all, really. But what we did in the next 3 years is converted it from conventional to organic. We got an awesome farm manager named Pablo from Chile who oversees it now, and now it's a fully organic orchard. Of course, organic is great for sustainability, but it's also really great for cash flow. Converting to organic basically means that we can double revenue. So we took this farm, which was doing about $4,000 an acre. Now it's doing $8,000. And what that means for investors is that they're getting a 31% cash distribution, not a 4%. How to invest in our partnership? We've currently have one main holding company called Gold Leaf Farming. There are 16 farms in the partnership currently. The reason we did a partnership rather than a deal-by-deal model is that it gives investors the opportunity to invest one check, say 100 grand, and instantly get access to 16 and more farms. This model provides good diversification if you want it. How will investment look? This is really a cash flow driven strategy. So say you were going to write a 100K check now, we'll start issuing distributions after next year's harvest. They will average about 15% per year for the next 7, 8, 9 years. And then we'll have a liquidity event, which might be a sale, a debt recap, or kind of a sale leaseback transaction. But how you should think about this is big cash distributions for the next 5, 6, 7 years, and then liquidity in year 7 to 10. The most probably compelling reason to invest now, or I'd say the most interesting question is really why now? And I'd say there's 2 reasons, one more macro and one more micro. From a macro level, you've got to think about correlation, right? So this graph shows how farmland is correlated with other asset classes. Historically, farmland has been negatively correlated with the stock market, but positively correlated with inflation. You see the CPI. So what that means is farmland provides an awesome opportunity to have a hedge against equity market weakness. I think a lot of us think that equity markets have been overvalued and there's some uncertainty there. So farmland traditionally has performed, in an opposite way towards equity markets. But farmland outperforms during inflation. So if you want to hedge against equity markets and something that'll perform well if inflation picks up, this is probably a good way to do that. Last but not least, these agricultural products are commodities. There's high prices and low prices. And it probably sounds pretty obvious, but if you buy low, you generally have better returns than when you buy high. So if you look back at almonds, for example, if you bought in 2003, which I'm sure you all know, that was a low year for almond price, and you look at returns over the next 20 years, you basically would have got a 10x on your money or 20% IRR multiple. If you bought when price was high, you only would have done 15%. That's not terrible, but it's not 20%. Right now, we're at a low price. That means that a lot of sellers are basically selling their best assets for liquidity. They're nervous, they're scared, and we are in an awesome position to capitalize on that. That's why we're raising money today, to get some growth capital and take advantage of this market opportunity. It's probably pretty similar to real estate, let's say in 2008, 2009, right after was a once in a lifetime opportunity, or investing in commodities after, whenever oil price is low. That's generally when the shrewd investors invest, not when price is high. So anyway, I know this was short. Really appreciate your interest today. Any questions that weren't asked, please reach out to me directly at josh@goldleaf.ag. We are taking commitments right now. We think it'll be open for the next 2 months, but we will reset our partnership valuations on January 1st. So if you want to get in at the current valuation and not the most likely stepped up valuation, you should invest before January 1st.
Okay, perfect. Thank you, Josh. We do have a couple of questions. That was actually going to be one of my first questions was, hey, how long is this open for? So revaluation in 24. So try to get in the next 60 days, it sounds like. Do you have a loan component for this investment?
We do. Good question. So farmland does use leverage, but it's lower leverage than other real estate asset classes. I think we're currently at like a 45% LTV across the portfolio. Fortunately, a lot of those loans were actually fixed before rates went up, so we're paying something like 5.75% on most of that debt.
And what's the minimum investment amount?
We generally say 100 grand, but that can be flexible if we have a partner that can, that's interested in starting with us now and maybe adding to that position going forward if we perform.
Yeah, maybe mention to Josh that you found him on WealthChannel or Expo, and he'll cut you a break. Hey,
Yep.
What about, let's see, our next panelist for our tax investing strategies, Sarah Sullivan asks, are there any tax deductions with this investment opportunity, Josh?
Yeah, so good question. And I promise I didn't pay her to ask that question. Farmland has a lot of bonus depreciation, right? So in the Trump tax plan a few years back, that enabled bonus depreciation, but only for improvements that had a 20-year or less life. All farmland improvements have a 20-year life or less, according to the tax code. So essentially, when we buy a farm, about half of it is attributed to land, not depreciable, but half of it is attributed to improvements that can be bonus depreciated immediately. That's different than, say, multifamily, where a lot of the structures actually have over a 20-year life, so they can't be bonus depreciated. All of our improvements can be bonus depreciated, not just certain ones that might fit a cost segregation study.
And then real quick, and then I got to get you out of here, is 1031 an option with this investment opportunity?
Right now, it's not, but similar to the last panelist, we're working on setting up a DST structure in the future. So it's not an opportunity right now, but it probably will be in 2024, probably Q2, Q3.
Fantastic. Please do reach out to Josh if you want to get any, if you want to request more information, get subscription docs, or talk to him more about this opportunity. His email address on the screen, josh@goldleaf.ag or investors@goldleaf.ag. Josh, got to cut you loose there. Thanks so much for joining us today.
Jimmy.
And your sponsorship of today's event. Really appreciate it. Thanks.
Thank you.